Lindsey Piegza. She is the chief economist at Stifel. Lindsey, I did not have a good idea which way this number was going to go, looking at the stuff we look at to figure out which way it's going to go. Do you have a good feel for it?
Well, I do think that we're going to see further indications of labor market conditions cooling, with that top line number coming in closer to 200,000. So right around that consensus figure, and average hourly earnings further cooling down to 4%. But the unemployment rate, I'm not expecting much move here, still stubbornly low, around 3.6%, suggesting that labor market conditions do remain tight. And this is going to complicate the picture for the Fed, because any indications of ongoing resilience, this is positive for investors, that at least in the near term are going to suggest this is further evidence for a soft landing, the idea that the Fed can entirely bypass a recession. But I would argue that the longer the labor market continues to push against the Fed and fails to bend to tighter monetary policy, the more aggressive the Fed will have to be, ultimately resulting eventually in a more sizable downturn of the U.S. economy. So it's going to be somewhat of a mixed bag in today's report.
But isn't it a real question as to whether or not the job market is even driving inflation right now?
Well, I think for the Fed, there's a number of different components that are driving inflation. Yes, we see wage inflation, absolutely, perpetuated by the notion of demand side inflation. But there's other components stemming from supply side, stemming from what the market is calling greedflation or corporate policy. That's outside of the Fed's purview. The Fed isn't able to control those factors. So right now, for policymakers, they're focused on the components of inflation that they can control. And one of those largest components is that wage component, because Fed officials very much fear the wage price spiral, where wages continue to rise, but prices rise in lockstep, continuing to elevate the cycle of inflation. So for the Fed, that's the primary focus. They know they can control that, and they will continue to raise rates until they see progress in that underlying wage or demand component of inflation.
Go ahead, Andrew.
Hey, Lindsey, I just wanted to go back on this idea that you believe that they can control wages. I'm not sure that even they think they can. I think they have to try. But as we were talking about last week when Paul Krugman wrote this piece about discombobulation and recombobulation as effectively a scientific economic term, if you will, that all of the work that's happened post-pandemic, he suggested, that is not all the work that's happened on inflation has not actually necessarily been fully a function of the Fed, so much as it's been all these other things which Steve and I think others have been alluding to.
Well, absolutely. Again, there's a myriad of factors that have influenced inflation and driven price pressures higher. But again, the Fed can't just sit back and say, well, we have to wait for market metrics to clear back to an equilibrium, bringing us back to hopefully that 2% target. The Fed has to work with the tools that they have. And what they have is the ability to continue to raise rates, to tap down investment, tap down demand, eventually leading to a slower level of top-line activity, a weaker labor market, and by extension, then more benign demand or wage-driven inflation. And
Lindsey,
so the Fed is very aware that they can't control all components, but they're going to work with what they have.
Lindsey, I'm going to just do some reporting with you for a story I'm working on for next week, okay?
We'll watch.
Yeah, just watch. Okay, here's the deal. What if the Fed has this really wrong? And what's happening is there's this productivity increase. And people and the wages they're getting are, by definition, if they're spurred by or underpinned by high productivity, they're not inflationary because people deserve that money because they're more productive and efficient. Now, I don't want to go too far with the recent productivity numbers we had because it's one quarter. But if you look at what's happening, and I'll explain all this next week sometime, we have had GDP at or above potential with declining inflation. If those are the only two numbers you had, Lindsey, wouldn't you say there could be higher productivity in the U.S. economy now than we've given it credit for?
Well, I think that would be ultimately a very positive story. Unfortunately, I don't think that's the case. Now, we have seen somewhat of an uptick in productivity from record low levels. The U.S. economy was seeing less than half a percentage point of productivity for a prolonged period of time. But as we've seen in the recent reports, businesses are actually reporting a downturn in productivity as a result of the work from home environment. So right now, I don't think that we can justify the rise in wages as a result of an increase in productivity, an increase in output, and thus concluding that this is less inflationary for the environment, for the broader economy. So I do think that that would be more of a Goldilocks scenario, but unfortunately, that's not what the data suggests at this point.